Okay, I think we can get started. So we're happy to have Esteban here talking about the economic geography of global warming. We go for an hour. If you have a question, just unmute yourself and break in. We also have Jose Luis in the chat room, so you can ask questions there as well. And then we'll have time for questions and more discussion at the end of the seminar. So Esteban, go ahead.
Great. Thanks so much for having us. It's great. It's great to be here. And so this paper is a paper trying to evaluate the consequence of a particular aspect of climate change, which is global warming. And the idea is to try to build or propose an assessment model that we can then use to understand the effect of policy, understand what are the key aspects of the phenomenon, and the ways in which the economy is going to adapt to it. And so the way we're going to construct this model is by first thinking about what are the key aspects of this phenomenon that we want to address. And so the first thing is to recognize that global warming is a very protracted, namely it happens kind of slowly over time, global phenomenon that is affects the whole world because it involves a global externality. Everyone emits carbon, which in turn makes the earth warmer. But even though there's this global externality, the effects are very heterogeneous at the local level. The temperature changes involved or implied by a certain amount of emissions, global emissions in carbon, are very different if you think about regions in Siberia relative to the regions in Central Africa. And so recognizing that heterogeneity is going to be kind of one of the things that we're going to emphasize in our model, and recognizing that the heterogeneity also kind of imposes, in some sense, a way of approaching modeling this type of phenomenon. Now, the other thing that is kind of that we're going to try to do is, in some sense, I mean, this sounds a little bit pretentious, but let me say it anyway, is to try to kind of bring modern economics into these integrated assessment models. And many of these models, the way they work is that, you postulate a loss function where, there's some aggregate economic losses depending on the level of temperatures or some other climate variables. And so there's kind of a set relationship between aggregate economic outcomes and these climate variables, instead of, as we normally do in economics, have kind of a micro-founded model in which there's economic agents, individuals, firms that make optimizing decisions and therefore react to whatever is happening to them in an endogenous way. And so that is going to bring in economic adaptation that in turn is going to change potentially the relationship between these climate variables and our aggregate outcomes as a result of policy or climate shocks themselves. And so we want to kind of incorporate these kind of micro foundations and kind of the implications of micro foundations for adaptation, but come with it. And we want to do it in a world that recognizes this spatial heterogeneity of climate damages. And so we're going to propose such an assessment model. And once we have such an assessment model, of course, that assessment model is going to put particular emphasis on certain forms of adaptation. And I will emphasize them as we move along. But the three key ones are going to be migration. So we're going to allow people to move across locations kind of in a costly way that I'll describe. There's going to be trade, of course. And there's going to be innovation in the sense that locations can improve by having the firms in those locations invest in making the local technology better. And so these three forms of adaptation are going to allow individuals to react to the effect of climate change in a way that is going to affect the local and the aggregate implications. Okay, so. Yes.
Sorry, just a very quick question on the previous slide. Why do you want to have innovation and not just say agglomeration economy, some shortcuts to it?
Right. So that's a good question. Well, I mean, so the key, we think that an important aspect of this phenomenon is that because it's so protracted, because it happens so slowly over time, and because we have to think about, tens or hundreds of years forward in some sense, we want to have an evaluation model that allows areas that are today not populated, or where today, there is not a lot of economic activity, to have a chance to become better, to have a chance to develop, right? Because otherwise it's like, I'm saying, well, let's, global warming comes, and it's gonna make some regions, say in Siberia, better in the sense that they're gonna be warmer, etc. But because today there's nothing there, I'm gonna assume that it's impossible to ever develop those areas, right? Because I'm going to kind of read them as those areas being kind of low productivity, etc. And so what I want is just give the model an opportunity to say, no, maybe in 200 years, it's perfectly feasible to develop a bunch of cities over there, that are gonna potentially be as good as the cities that we have in other places today. And so I wanna have that mechanism in there because I think it's potentially a source of adaptation for the world.
And I won't keep you long, but agglomeration economy. So Siberia gets better and people start moving, even if it's low productivity. And the fact that people move make it more productive and make it even more appealing for more people to move.
Yeah, I'm gonna have some of those mechanisms too. In the model, so there's still also going to be agglomeration effects, but agglomeration effects don't necessarily work the way you described. They also work in the other way, which is that it creates persistence of the economic geography that you see today in the world. So it also makes destroying in some sense, or moving away from the cities that are already built today harder. Right. So that mechanism actually can play against you, not in your favor in that sense. Right.
Okay. Thanks.
But I think those trade-offs are exactly kind of what we want to be thinking about. And so we want to kind of bring in those elements into the model, and potentially, think about what's their role and how important they are, etc. So that's exactly the discussion that we want to bring in, and we think that it's a discussion that, in some sense, this literature hasn't had yet. Okay, so very briefly, the literature review. I mean, if you think about like the literature on climate change in general, well, there's of course like a set of papers that try to measure directly the impact of temperatures or other forms of impact of climate on economic outcomes. We're going to kind of rely on some of that literature to measure for some of our quantification. Then there's a literature that proposes integrated assessment models. Many of those papers have many of the features that I was describing before. Some others are microfounded, but for example, don't recognize the heterogeneity in space. Certainly, all of the ones I have here, they don't have heterogeneity in space or any sort of form of adaptation across space, namely locations are not trading and there's no migration, etc. And so in some sense, they focus more on the dynamics than on these kind of cross-sectional adaptation mechanisms across space. There's of course, bringing in space and dynamics has its challenges. Is something that I've spent a lot of time on. And this paper is going to rely on some of the previous work I've done with Klaus Desmet and David Nagy that proposes kind of one of these spatial growth models, and that's going to be one of the core of the model that I'm going to propose today. And of course, Lorenzo and Fernando and etc. have also worked on dynamic models. Those are more about kind of adjustment costs of aftershocks. The models that I've worked more on are models more about growth, and therefore introduce this kind of innovation mechanisms that we were talking about with Cecilia. And so that's what we'll use because of the reasons that we just discussed. And then there's a literature in the interaction there. I mean, I have several papers there with Klaus particularly, but Claire Balboni has a nice paper on flooding, and Nat had a nice paper in the job. He was on the job market this year. A nice paper on kind of sectoral effects of climate change as well. Okay, so let me just give you like the model in a little diagram. I mean, the model has many parts, and it's kind of a little bit heavy, and so I'll talk about it. I'll talk about particular parts of it that are more relevant to the discussion today. As I said, is based on this paper I have with Klaus and David Nagy. And so you can think about the core of the model in that paper is the part in the diagram that is black. So this is a model in which there's going to be locations, people live in those locations, supply their labor or inelastically in the market, and then firms use that labor together with land to produce. They can trade with others, and they're going to decide whether they want to improve their technology by investing in innovation. And so if they do, that's going to affect their productivities, and they're going to, produce using that technology and these factors that they hired. They're going to pay wages and rents to the individuals, and then the individuals, looking at the real wage that they receive in a particular location and the distribution of amenities across locations, are going to decide where they want to live, subject to migration costs, the fact that they can pay migration costs. So that's a model. It's a model of growth in the sense that because there's that innovation that I was talking about, locations are kind of going to become, their technology is going to improve over time, and the whole economy is going to eventually converge to a balanced growth path. But where locations where there's a distribution of population across locations. So that's the core of that paper. What are we going to add to it? Well, the first thing that we're going to add is another factor, which is going to be energy. So production is going to require energy as well. And energy you can produce using either clean energy sources or fossil fuels. If you use fossil fuels, that's going to generate CO2 emissions, which are going to add to the CO2 stock. And we're going to have like a carbon cycle that is going to determine how that those CO2 emissions kind of go into the stock of CO2 and affect global temperatures that in turn are going to affect local temperatures in a way that is going to depend on the location. Okay, and so the heterogeneous effects across space are going to come in part because global temperatures are going to convert into different local temperatures depending on what that location is. And then an important part is going to be that these local temperatures in turn are going to affect productivities and amenities. So how nice it is to live in a particular location, or how productive are firms in that location, is going to be a function of these local temperatures. And we're also going to allow natality rates, so birth minus death rates, to be affected by the local temperature. And so that's going to imply that agents are going to have kids in that location based on that relationship between income, temperatures, and natality rates. Okay, and so those are kind of the elements of the model. We're then going to quantify everything at the 1 degree by 1 degree level using GECON data on population and income, and we're going to have trade that satisfies gravity, and it's quantified in the standard way that we all know. And there's going to be and we're going to have migration costs that match net migration flows in a particular period of time. In our case, it's going to be 2000 to 2005. So that's kind of in a nutshell what we are going to do. Let me unpack that a little bit. So,
Esteban, just before you jump ahead, go back 1 second. So how will the connection be between innovation in this production sector and the extraction and clean energy sectors? There's some sort of spillover.
Yeah.
So that's technology.
Good question. I'll get there.
Okay.
I think I have a slide that is a little bit more detailed. Let me just give you an answer real quick. which is this innovation is going to be innovation in technology to produce goods. So it's not going to be innovation in the technology to convert clean or fossil energy, fossil fuels into energy, but we're going to have a spillover from this technology into this sector. So kind of what you said. Okay, but we're not going to have, or the version that I'm going to show you today is not going to have purposeful investment in energy saving technologies by the firms.
Okay.
Okay, so agents have, so think about an agent that has a history of where she has been, denoted by R bar minus here, is in a particular location R today. These are the preferences of these agents, kind of the period preferences of this agent at time t. So she consumes a basket of products, aggregated CS. Then there is a local amenity BTR that depends on the location and it varies over time. There's an idiosyncratic preference for the different locations that is going to come from some distribution. And then there is the migration cost. And the way to think about this migration cost, or the way we're going to model migration cost, is like a flow cost, right? So if I move from Mexico to the United States, I pay this cost, and it's like a flow cost that I'm paying forever. And then if I move from the US to Germany, I pay another flow cost, and so on. And so I'm accumulating flow costs over time, and so that's the way we're going to introduce migration costs. And so that actually simplifies a lot if we allow migration costs to be quote unquote reversible, namely the assumption that I have at the bottom here, namely that bilateral migration costs have like a origin component times a destination component. Why? Because then together with the assumption that if you stay in the same place, you don't have to pay migration cost, implies that this way of formulating migration costs is such that I pay the migration cost from being in the US as long as I'm in the US, but then if I kind of return to Mexico, I stop paying it. It's kind of, I reverse it. And so in some sense, the beauty of it, if you will, I mean, it's restrictive to some extent, of course, but the beauty of it is that this kind of makes the migration choices static, right? Because they're always reversible. I can always reverse them if I want to by going back. Okay, so we're gonna do that. That's gonna simplify our life. So that's the way we're gonna model migration costs. And so there's gonna be kind of a one-dimensional migration cost, right? That we're gonna have to quantify. And like I said, we're gonna quantify so that the model matches the flow, the changes in population in each location over a certain period of time. And so because we're only matching gross changes in population, because we're matching only net changes in population, this gives us enough degrees of freedom, if you will. The second thing is
Esteban, the migration. So the migration costs, it's not really like a.
I hear you barely. Can you speak up a little bit?
Oh, sorry. Does the migration cost show up in the resource constraint, or this is just utility terms?
It's just utility.
There's no like, it's not really costing anything to move people around in terms of like output or anything. That's what you're saying.
Yes. So it's only restricting people from moving, right? But it's not costing the economy as a whole resources. Yes. I mean, it's making people unhappy, but that's it.
Yeah, I guess it's like about the trade-off of like today versus tomorrow. Is like moving people around is going to cost, output, and that's going to be foregone relative to. And there's other choices here too, like innovation. So it's that's why I'm kind of asking about this.
No, I mean, I think that it's a good question, and obviously, one can argue that there's real resource costs involved in moving. We don't have them. We don't have them. So we just have like this utility cost. But I agree that, I mean, obviously the game that we're playing is one in which the model is going to be kind of detailed in the spatial dimension, but we need to simplify the dynamic dimension, and this is a way of simplifying the dynamic dimension on this front. But okay. So then there is this amenity, this B, right? And this B is gonna have some agglomeration effects or some congestion effect. So namely, partly it's going to be determined by how many people live in that particular location. This lambda we're going to eventually kind of quantify as a positive number. So this is a congestion force. And then the other part that is kind of related to what this paper is about is that we're going to allow temperature to affect these amenities, right? And so in particular, changes in temperature are going to affect the level of these amenities, and this kind of damage function, this gamma is something that we're going to estimate, and we're going to allow it to also depend on the current temperature. So the change in temperature, of course, is different if you're a very cold place than if you're a very warm place, okay? And so this function is to be estimated and depends on the change and depends on the level, okay? So that's the preferences of individuals. We're going to
Esteban, just in terms of the amenity, you're not allowing people to make endogenous choices to build skating rinks or, you know, when it gets cold or anything like that. There's no infrastructure investment that would shift out that B. It's all kind of working through people and,
yes,
and temperature.
That's right. That's right. So in principle, I think this model could be altered to do some of that, but we haven't. So it's all operating through this congestion force, which is kind of like an externality, and then the direct effect of temperature on amenities here.
Do we have some sense where you can deal with the temperature? Like, you know, I've been to Arizona in the summer, and it's actually not so bad with air conditioning.
Yeah.
I mean,
no, so you can think, right.
Is there something you can do like so that it's not a big deal in a certain space of the temperature range, or is there some like restriction you have on it by making it, I guess, like almost constant elasticity?
I'm gonna estimate this function. I'm gonna let it be kind of pretty flexible, and let's see whether there's a plateau there somewhere. Okay. Yeah. So I'll show you that in a second.
I wonder if, just to answer Georgia's question, if in some sense, as the example of the air conditioning, it would show up in the data as just reducing productivity more because you're wasting resources and not affecting amenity as much.
Right. That could definitely be the case. I agree. But I mean, we're just going to estimate whatever that relationship is, and we're going to put it in the model.
So in a sense, you are accommodating the air conditioning is what
right. I mean, you can keep unpacking this, of course, right? I mean, at some point, I mean, all these functions, you can keep unpacking them, and I think there's an interesting agenda of trying to do that. But you know, this paper does it up to some point, right? I mean. Now, and so these are the offsprings. So people are going to have offsprings given by NTR, or this is kind of the net of deaths or births minus deaths. And so that's going to change population in a particular location. And that matters, of course, because it puts people in a particular place, and kind of moving out of that place is going to, you know, be affected by these moving costs. And so where kind of people are born is important. And we're going to allow this natality rate to also depend on temperature and also depend on income. So kind of like Beckerian type of quality quantity trade-off. We're not introducing that in preferences, but we're going to allow income and temperature to come to affect this function that I'll show you also later on. And so that's going to, you know, lead to population growth or decline in the world, you know, by adding up. Okay, so that's the.
Yeah. Yeah, hi. So I had two questions. The first one was just on to understand the notation, the delta T that you were writing.
Yeah.
Is the change in temperature from T+1 to T. It's not local variabilities. There's no notion of extreme heat or extreme cold, which is more damaging than. Is that correct?
That's exactly correct. So there's no extreme events in this model. In principle, you can bring extreme events in. We won't. So this is just going to be given a certain level of increasing global temperatures, what's your local temperature effect? And I'll show you how we calculate that in a second.
And my second question was on natality rates. Is it equivalent from a welfare perspective to load everything in net natality rates? Or if you were to model natality rates separately from mortality rates, would that, because like when people are born and then die, I guess that has welfare consequences. But if they're never born, then it has less of a welfare.
Yeah, I mean, there's a whole topic here about how I value future populations that, of course, if you think about policy, is going to be huge, right? And that I'm gonna try to avoid as much as I can and tip around so that I don't have to get in there. Because I mean, of course, a lot of these policies, once you bring in natality, all these policies are going to change population size, right, in the future. And so, you know, they have economic effects per capita, but they also have population effects, and you have to, you need to, you know, evaluate that in some way, right? So which kind of is related to what you were saying. Okay, so this is production. Think about this as production per unit of land. So everything is normalized per unit of land. Think about a production function that is constant returns to scale in labor, energy, and land, but I'm already dividing by land, like I said. The productivity has two components, has a productivity draw as in, you know, EK, and then it has purposeful innovation, this fee that costs the firms in terms of units of labor, or in terms of is indexed by the wage. And then there is, you know, the labor that you hire raised to some power, and then the energy raised to, you know, 1 minus that power, and then all of this raised to the 1 minus the share of land, which we're calling mu. Okay, and so purposeful innovation is going to come through here, and firms are deciding on that fee, you know, given the cost of innovation. And why do they want to innovate? They want to innovate because they're competing with other firms for a plot of land, and you know, so in order to gain to be able to bid or offer the highest bid for that bit of land, it's good for them to improve that land by innovating on it. And so they're going to do that, and then they're going to bid for land, but they're in equilibrium, they're going to bid for land or everything that they get from that innovation. And so after paying for that innovation, they are actually getting zero. So what that means is that there will be innovation, but the profits from today on, right, are going to be zero, and are all going to be embedded in the fixed factor, which is land. Okay, and so that's kind of the trick in the papers that I have with Klaus that makes the problem have innovation and have growth, but it's not forward-looking. I mean, it is forward-looking, but it's not. You don't have to deal with the dynamic problem in the sense that for the firm, from the firm's perspective, the firm just looks at zeros. Why? Because everything is embedded in the value of land. Now, if something happens in the future, right? That's not going to have a locative effects on these firms in the sense that it's not going to change the decisions to innovate. The only thing that's going to do is going to change the price of land, right? So that's the way this is going to be reflected here. And so that kind of simplifies the dynamics of these models quite a bit, but still keeps some of the growth effects and kind of differential evolution of productivity across locations that we wanna keep in. Okay, so now this productivity draw comes from a distribution that has level A, and this level A is, we're going to do the same that we did with amenities. Is going to kind of have an agglomeration effect here. Cecilia, this is what I was talking about before, that depends on the number of people in that particular location to some power, and then it evolves according to this equation that I have here at the bottom. So this equation has many pieces, so let me go through that. You think about, well, it depends on what was the level yesterday, and then you add the innovation, which is this fee, so that kind of shifts the distribution over time. Then we're gonna add some diffusion here. This diffusion seems like a wrinkle that we don't need, but it's actually important because that's needed in order to guarantee that this is all going to converge to a balanced growth path, which is kind of something that we like. So we're going to keep it. And then the part that is relevant for today is we're going to also add a damage function here that is going to depend on the changing temperature and the level of temperature, the same way we discussed for the amenities, okay? And then the last piece that I'll describe in a little bit of detail is the energy component. So energy is an input in production, and you can produce energy using fossil fuels or clean sources. We're going to aggregate those with a CS. Elasticity of substitution is epsilon. That elasticity of substitution is important, of course, in determining the effects of policy, etc. And then we're gonna have like the cost of this energy, and the cost of this energy is going to depend. For fossil fuels is going to be given by this object here. And what is this object first? So one force that we do want to bring in is the fact that if you use a lot of carbon in the world, eventually you use it all up, right? So eventually you kind of, it becomes more and more costly to use carbon because you have to, I mean, I guess the thing that I have in my mind is you have to dig deeper and deeper, right? And so it becomes more and more costly to use that last bit of carbon. And so this function is going to be a convex function that is making the cost higher the more cumulative emissions you've done in the past. And then we're going to have these things that divide, that we're also going to have for clean energy here, that bring in technological innovation in the energy sector. And that we're gonna link to the innovation that we have, like the endogenous innovation that firms are doing for other purposes, for their own purposes, as I described a minute ago. But that's going to have some effects on clean energy. Of course, alternatively, you could have these firms, clean energy firms, do the innovation themselves. But then you need to think about how you bring that in with the use of land, etc., which is something that we haven't done yet. So for now, it's just kind of an externality from the innovation, that the endogenous innovation that happens in the regular production sector. Okay, so that's, and the only thing that we're going to allow is for that innovation to have different impact potentially on clean energy and fossil fuels. And why do we do that? Because we see clean energy kind of evolve a little bit faster than fossil fuels. And so we want to be able to bring that in quantitatively. And so that's going to make this parameter here a little bit larger in the clean energy sector. Okay.
Esteban, sorry, just to understand the previous, the F cum CO2, the fact that you run out of oil, is that so that you get a balanced growth path? Is it global warming eventually peters out?
I'll show you exactly the function that we'll use in a second. But yes, I mean, so what happens is that eventually you kind of use it all pretty much, right? And so there's no more effects on temperature, and the world economy stabilizes and gets to the balanced growth path.
Okay, got it.
Can I ask a small question here, please?
Sure.
Yes. So now this the F function in your cost for fossil fuel. Do you have any room to interpret or include carbon pricing?
Sure. But carbon pricing is going to come. I mean, I'll show you the effects of a tax on carbon, and so a carbon tax, and so that is going to enter here, right? So that's going to affect it's going to imply a gap between the cost of fossil fuels and the price of fossil fuels. Okay, so I'll do that a bit later, but this is very important. I mean, and then this is what I was talking about before, and then trade works in the standard EK way with iceberg transfer. Okay, so let me.
Esteban, I have one more question before you go on, which is on the technology, the fee terms, and you're tying them very closely to the geography, which I think one really nice example of exactly what you're doing would be like coming up with hybrid seeds, because that has to be kind of redone for each region depending on the weather, and then So that makes perfect sense. And then that would diffuse locally. But then there's another example, which would be through people, like in the Lucas model, where you run into other people.
Yeah.
And that is a little less clear because you have people moving around. And then, of course, if you thought of it like Romer, then this would be totally crazy because it's just these blueprints that shouldn't be tied to geography at all. So I just wanted you to get you to speak to that, because I always find that's the part I have a hard time getting my head around in this model.
Yeah, I agree. I agree with you. So the way, I mean, let me just describe first mechanically how the model works, and then we can discuss kind of, in some sense, the flaws and benefits of it. So the way it works is that there's this local diffusion, and this local diffusion implies that the firm innovates, and then tomorrow, firms can access that technology and kind of innovate on top of it, right? Innovate on top of it. And so that implies that this competition for land always keeps the dynamic profits equal to zero. So that's this fee part. But then we have this integral part here, which that's more like what you were saying, which is the technology in a particular location affects, so the television is invented somewhere, and then, lots of places can have access to it, even if they don't invent it themselves. And so that actually we have here. So this is that type of diffusion of technology across space. And this kernel D that we introduce, that if that's kind of distance dependent, then you would have something that diffuses at the regional level. If you make it flat, then it's something that diffuses last in Romer's blueprints that can go anywhere, right? So that diffusion we're bringing in here. I need that diffusion to happen, because if you don't have this, then what can happen is that some regions kind of fall behind and they never recover, right? And so that's not consistent with a balanced growth path, because you start getting these kind of areas where there's no one, because technology just falls behind completely. And so what this guarantees is that all places kind of keep up, at least to some extent, through this diffusion. And that's actually, you can show that without that, there is no balanced growth path in the model. So there's a little bit of it, but what we obviously do not have is this idea of, I'm a firm, I'm investing in my technology, I own it, and then I decide where to go in what locations do I enter with that technology. That, of course, would be very nice to have, but this model doesn't have that. I mean, that's
I guess you're going to discipline like those coefficients by like private and public returns to innovation in some way.
I mean, we're not doing it here. We did it in the other paper using the relationship between, okay, so let's first of all, I'm thinking these coefficients, right? The theta and the gamma, the cost of innovation and the extent of, those we're gonna get from relative growth rates depending on the distribution of economic activity.
Yeah, no, I guess what I was just saying was, in some sense, like, I'm fine with this setup as long as you kind of discipline those coefficients in the right way, where we kind of think about the appropriate private and public returns, so that we don't kind of.
I agree. I mean, I think there's clearly room for improvement given what we do. I mean, I'm not going to really talk about these coefficients because we're essentially borrowing them from the other paper. But in that paper, what we do, which I like, is that we once we quantify the model, we do this backcasting exercise where we check how the model is doing as we move backwards in time, because of course you can reverse time, right? So you can try to predict the past with the model rather than the future, and then contrast that with outcomes in the past that we can observe, and we think the model does fairly well. And so that's kind of the over ID check that I can offer, right? And so in that sense, I think we felt that was a success. I mean, you be the judge of it. Okay, let me go on, because time is running short. So then, you know, because firms are using energy, and part of the energy that they're using is fossil fuels, they are emitting carbon into the atmosphere. And so we're going to take like a standard carbon cycle model from the IPCC 2013. So that's going to lead to changes in temperature. And then we have to go kind of in total stock of carbon, and that in turn to changes in temperature for the world as a whole. And then we have to go from there to the local temperature. So we have to do this downscaling. And this downscaling we're going to do with this function here that follows a well-known paper by Mitchell here that tells you that, you know, this is kind of a good way of doing it. We've been a little bit more flexible than this, but doesn't really kind of do more much. And so this kind of term, the GR, is how do you translate changes in global the temperatures into local temperatures, right? And so we're going to estimate this parameter kind of at the local level based on a bunch of local characteristics of these locations. And so that, you know, and the other people have done it, etc. You can compare with them. We think this kind of does a good job. And so here it is. What you get. So this is the G's, right? So I'm showing you the G's that depend on the location. So this is telling you by how much does the local temperature change when you change the global temperatures by 1 degree, right? So everything that is kind of light blue, you change by 1 degree. Everything that is black or very, you know, dark blue is it's only about half a degree. And everything that is dark red, kind of only here in the north, you change it by about 2 degrees. And so you see the heterogeneity that you generate from the same kind of global emissions in carbon. The local effect on temperature is very, very different, right? So by a factor of 4 or so, depending on where you are in the world. And so this is one of the sources of heterogeneity of the effects of climate change. Okay, so there's a lot of parameters in the model. Like I said, we're going to borrow a lot from the other paper in terms of the basic economic model. And let me focus on a few that are relevant for the climate application. The first one is this elasticity of substitution between fossil fuels and clean energy that we're going to set to 1.6 based on these papers. But you know, it's something to discuss, because I mean, of course, there's a sense in which that parameter is also kind of the result of policy, right? So how substitutable these two types of energy are. So depends on the type of machines that you have in place, etc. May change over time. So there's something to think more about. We're gonna set it to this value for now. Then let me go into a little bit more detail into 3 things. The first one is this extraction cost function that we talked about. That's the F that depends on cumulative emissions. There's data from Bauer et al. That have calculated how, you know, costly it would be to get the carbon at different, you know, in different parts of the world, depending on how much you have emit. That's the green dots. We're going to fit a curve on that. And that's the black curve. And that's the one that we're going to use. And so as you can see, it's very convex. And so what that means is that the more you use, the higher the cost of extraction. Now that, of course, is going to bring in this trade-off by which, if, for example, I use less carbon today, that implies that the cost doesn't rise as much. And so tomorrow, using carbon is going to be cheaper. And so I'm going to tend to use more of it. Okay, so that this kind of convexity is going to imply that type of effects. Very important is these damage functions, right? So these damage functions link temperature and changes in temperature with both amenities on one hand and productivity on the other, okay? And so the first thing that we're gonna do is we're gonna take the model, we're gonna invert the model for 4 different periods, so 1990, 95, 2000, and 2005. That gives us amenities and productivities for all these years. And then now we have a panel, right? And we're going to use this panel to try to estimate the effects of temperature, both on amenities and productivities. And so we're using, you know, fixed effects to at some level, we're trying to control for trends, and we're allowing the semi-elasticity to vary depending on the local temperatures. And so what that gives you is these functions here, and this relates to something that you were asking before, George, or a comment that you were making before, which is, well, maybe there's like a plateau in the middle. So here is where you would see it, right? And so what is this telling you? It's telling you, if you are in the coldest places in the world, right? And the temperature that we're using is January temperatures in the northern hemisphere and July temperatures in the south. If you're the coldest places in the world, a 1 degree increase in temperature, right, is good for the amenities. So increases amenities by 2.5%. That's what that number would tell you, right? And then, you know, you as temperatures go up, this effect kind of declines, and then eventually it becomes negative, meaning that, you know, warmer temperatures are actually bad for amenities. And so you get to something that is this, you know, more or less symmetric. Now, as you can see, there's a lot of uncertainty about, you know, the optimal level, the optimal temperature. It kind of varies, you know, where exactly is the zero here is not at all clear. There's a lot of uncertainty about exactly the level of these functions, but there are some significant effects here for sure, and there's some significant effects kind of in both extremes. And this is the same thing for productivities. Again, significant effects there, significant effects here, but lots of uncertainty in the middle, right?
Esteban,
yeah.
You're identifying these things off of migration in the periods and the years that you showed from 95 all the way to 2005. How do we know that migration was primarily driven by temperature changes and not, say, wars in hot places like the Middle East, the people moving to Europe? Or then I'm wrong on the identification. Go ahead.
Yeah. So I mean, migration is certainly part of it, but it's not the only part of it. I mean, I see whatever the economy that I see, right? From the lens of the model, I can invert the model, and that gives me these fundamental things, these amenities and these productivities, right? Through a standard inversion of the model, right? And that's the data that I'm putting in. And so that depends on how people move in part, but it depends also on the changes in productivity that I see. It depends on all sorts of things, right? It doesn't only depend on the migration patterns. And so once I get those guys, right, I'm estimating this. Now, that it is important, as you said, that, you know, there's all sorts of reasons why particular locations are productive of have a lot of people that have nothing to do with climate, right? And so part of it is everything that is endogenous in this model is part of the mechanisms that I have included in the model. Well, that I'm already taking into account through the inversion, right? And then on top of that, I'm allowing for these kind of location fixed effects at a slightly more aggregated level than the 1 degree by 1 degree. I think these numbers that I'm showing you are, at, you know, for 2 squares rather than 1.
But I would still do some robustness checks by dropping large regions that either received or saw an outflow of large migrations, or there were wars and some type of.
Yeah. I mean, no, I mean, I think that's a good question. I mean, if you see a war and the war, you know, displaces a lot of people, I mean, there's a view that, you know, whatever happens is kind of part of this phenomenon, and these are particular expressions of this phenomenon. Of course, you can say, no, there is some idiosyncrasies here that I want to take out. To be honest, I'm not exactly sure which one is best, but I hear what you're saying. And I think doing some robustness is useful. I think
especially flows that are kind. Yeah, go ahead, sir.
The fixed effects and the time trends are going to capture some of it.
That
right?
is true.
So
yeah. Yes.
So we're trying to do a lot of robustness checks on this because, of course, these functions are important. Now, one key thing is that, you know, given what we are doing, and obviously, and these are kind of our preferred estimations, there's still a lot of uncertainty. And partly, and a lot of this uncertainty is coming from the fact that, you know, climate has had an effect, but it has a kind of a limited effect so far. Right. And so there's only so much variation in the data that you can use to estimate these functions. I mean, so you're in some sense kind of a little bit limited by that as well. Right. Okay. And then there's the natality rate as well. There we're using some of the evidence in Deventhal and Greenstone to try to, I mean, the way we're parameterizing the natality rate is is a function of income. So So it depends on, so that's like the Becker quantity quality. So richer countries have less kids, and then and there's a part of a temperature that we're getting from the effect of from this paper by Princeton and others. And so that's going to imply that natality rates vary with GDP, and that they vary with temperatures, kind of in this kind of inverted U-shape pattern. Okay, let me just say that for now, because I want to show you some results. Okay, so I understand that this was a little rushed, but once you put it all together, what you can do is you can run them all forward, right? And so what I'm going to show you is the simulations in this baseline case, and then I'm gonna do some changes and kind of try to decompose it to some extent. Okay, so this is outcomes. We're starting the simulation in 2000, right? And then for 400, this is just pushing it forward for 400 years. Like I said, eventually it's going to stabilize, because eventually you reach this balanced growth. And so what this is showing you in the green line is the model implications for CO2 emissions over time. The dashed line is the IPCC prediction for an extreme scenario, RCP 8.5, which the RCP is kind of a label for how extreme the scenario is. RCP 8.5 is one of the most extremes that they have, and the RCP 6.0 is kind of the dotted line there. And so they have, and so you can see kind of that this kind of closely resembles the rise there, and then endogenously it starts declining. They have it just like at some point you have an abatement technology, it comes down. For us, it comes down endogenously, because eventually kind of you run out of carbon, and so you start pushing the cost of carbon. And you can see how like the implications for temperature are very close to that scenario of the IPCC. So we're getting something. I mean, this is an endogenous curve, of course. We're getting something that is very similar to that scenario. So in some sense, it's not giving us something crazy in that sense. And so what does that imply for amenities? So this is our amenities in 2200 relative to no warming, or productivity relative to no warming in the same year. So you can see what happens. What happens is, these areas in the north become nicer to live all throughout, like parts of China and Mongolia. And then, a little bit in the tip, south of Argentina and parts of Australia, but less so. But then look at the magnitude. So the magnitude is about 30% better amenities in these areas, about 60% better productivity in some of the coldest areas today in the world as a result of climate change over the next 200 years or so. Okay, and these are the changes in population that implies, so that you have in the baseline scenario. So there's a little bit of population change as a result of climate change. So overall population change as a result of climate change, but that's tiny. So that's about 30 million people that are less in the warming case than in the no warming case. So the overall population effects are small, but of course people reallocate, and so you're going to have about 60% more people in some of these northern areas relative to the rest of the world. Okay, so and most of these people kind of come from Africa and parts of South America. So that's kind of the general thing. And so if you put it all together, then you have this. You can calculate the welfare effect. So this is kind of the present discounted value of that utility level that we discussed before. And so you can see who are gonna be the winners and the losers, or in terms of regions of this process. And is Central Africa, India, parts of Southeast Asia, and Brazil and parts of Central America are the kind of big losers of that. How much?
Esteban, one means no change.
One means no change.
Okay.
So sorry, yes. So one means no change. Red means 15%, and 0.85 is like a 15% decline, right? So this is it. And so So these places are losing about 15%. These places are gaining about 15%, and this is the distribution of those kind of population-weighted distribution. And so what you can see is that it's like a bimodal distribution, right? There's a bunch of countries here, which are the rich countries today, that lose a little bit, not much, right? And then there is kind of the big losers here, which are the poorest countries today, which are kind of in some of the warmest regions. And these are the areas that lose most in terms of welfare of that population. Overall, you get losses of about 6.5%. Okay. Now,
Esteban, could I ask a question about welfare? So I guess it's always a little confusing when you have migration. So is the welfare, when you say the welfare of a location, is that the welfare of the people who are in the location today? Yes. Or the welfare of the people who end up there, 200 years from now?
Good question. Is the people, if you are today there, what would be the implication for you? Okay. So that's this calculation. So is the welfare for someone here, understanding that they, may move wherever they move in the future, right? Okay. So, but there's there's a level to this distribution, but that level of the distribution depends on the level of those damage functions. And so what this is supposed to illustrate here is the confidence intervals. If I use the confidence intervals that I got from those damage functions and try to calculate the evolution of the average cost of climate change, what you see is that this is really, really wide intervals. So, in 200 years, it may be 20%, it may be essentially zero in terms of welfare overall, in terms of levels. Now, when I look at the distribution across locations, that bimodal kind of distribution in terms of welfare persists, is shifted, of course, depending on whether I'm in the low 95% or in the high 95%, but this kind of bimodal shape kind of persists. It's just kind of shifted up and down. And so the losers there are pretty much the same places, and there's a little bit of a change in the distribution, but not huge. And okay, so let me. I have like a minute left, right? So let me make one point about migration, and then I'll conclude so that I don't abuse of your time. So there's three key adaptation mechanisms in this model that I mentioned at the beginning. So people can move across locations, people can invest, or firms can invest in other locations, and therefore make them better, make locations that don't suffer from climate better. And then finally, there's trade. So what this exercise does is increases migration costs and looks at how the effects on welfare or climate on welfare change as a result of the increase in migration costs. So this is baseline relative to no warming and increases in migration costs. So the diff and diff, right? So everything that is red is hurt by the increase in migration costs. And so that's obviously the northern areas there. But interest and who benefits from it? Well, some of the areas that are going to be affected by climate, but are not that populated. In contrast, some of the places that are hurt a lot by climate actually are also hurt with the increases in migration costs. Why? Because they get poorer, and a lot of people end up living in those places, so they become congested and not so amenable. And so you get this kind of shape in which higher migration costs are bad for the north, but are also bad for some of the poorest areas here in Central Africa. But migration overall is the biggest adaptation mechanism. It matters a lot. And so if you increase migration costs by 25% here, you kind of double the cost of climate change in the baseline. Trade, on the other hand, has very little impact. Let me just go to the conclusion. Trade has very little impact in this framework. And the reason is that there's no sectoral effects. There's no specialization effects from trade. And so from climate. It's not that climate in this framework that we have right now affects a sector more than another. And so that implies that there's no changes in specialization. And therefore, although climate affects these regions, but it affects these regions in a correlated, a spatially correlated way. And because trade is, regions trade a lot with regions that are close by in this world, actually is not a great adaptation mechanism, because kind of in some sense, the people that you trade the most with are shocked in the same way as you do. So in this framework that we have here, trade doesn't do a lot. We have other frameworks in which we've introduced the effects of climate, differential effects of climate across sectors, and that has a much bigger impact. Okay, so thanks for listening. So we're proposing a new model to try to evaluate the effects of climate change, and in particular, in this case, global warming. You can use it for all sorts of things, for also to introduce many policies. In the paper, we introduce carbon taxes. Someone asked about that, and I promise, sorry for reneging on that promise, but you can introduce carbon taxes, you can introduce clean subsidies. We do so, and all of these policies have important spatial dimension and spatial consequences that it's important to bring in, and we think kind of the future of this type of integrated assessment models is to incorporate some of these effects. Thank you very much. Happy to keep talking, of course.
Okay, great. So now people can just break in with questions. If you want to raise your hand, you can do that too. We'll just leave the stream open for comments and questions.
I was going to ask, can you hear me? Is my microphone working
yes.
better?
Yes,
yeah,
better
okay.
now.
Okay, so like I guess back to my question with the mic, if there was like a physical resource constraint, that would make this even way worse, right? Because as I tried to move these guys around, there's just way less resources for adaptation through productivity or than just consumption as a whole. So the second thing though,
just to be clear, I mean, there's of course like a welfare. I mean, when I calculate the cost of welfare,
yeah, it's in there. It's just like it's not feeding into my point is it's not feeding into the other adaptation mechanisms, in particular the innovation.
It's true that it's not making, because there's no competition for resources in that sense. It's not making adaptation through innovation more costly. So that's right. That's interesting. I agree with that. Yes.
So the second thing is like those welfare numbers, what I'm thinking about is how should we interpret them when the allocation that you're starting with is not efficient? Like there's multiple externalities in here.
Definitely not efficient.
So there's a question, like you look at those numbers and is it purely just because things got bad through global warming, or is it because like people were in the wrong place? Or people not in the right place?
Yeah,
what I mean.
So that's a great point, and it's a point that really comes out when you look at kind of clean energy subsidies, because there's this effect, because this kind of diffusion of technology. Innovation is suboptimal, right? So you want to generate more innovation in this world, and clean energy subsidies don't really help a lot with climate, but subsidize at the end of the day, they subsidize production and therefore generate more innovation. And so that's good for the world overall, but it actually doesn't do anything for climate. In fact, as a climate policy, it washes out, because at the end of the day, the world ends up using more energy. And even though that energy is more biased towards clean energy, the increase in total energy actually implies that the total use of fossil doesn't change at all. So, or changes very little. So that's an example of that. So definitely. But I mean, we're always comparing with the dynamic path for the world without climate, or with whatever contrafactual you wanna calculate with. And so in some sense, if the current allocation is transitioning we're comparing relative to the transitioning that you would have without climate, right? So in that sense, I think we're doing the right comparison.
Yeah, it's the right comparison, but it's the question is like, what I want to know about the exact properties of the current allocation. Like where, like, are we starting off from a really distorted allocation, or is this not so distorted? I mean, I looked through the paper and I saw, like, I imagine it's really hard to figure out what the efficient allocation is, but
I see your question. So I don't know how to calculate that because the whole point, in some sense, this trick that I'm using to do the dynamics in this model, which is that everything goes into land, and land is a fixed factor, and so it doesn't react to that innovation, right? That of course, the planner of course doesn't care about that, right? And so the planner has a full, heterogeneous location dynamic problem, and so you have to crack that problem to crack the to calculate the optimal allocation. So everything, all these kind of in some sense shortcuts that work in equilibrium to calculate the optimal allocation, you have to get rid of them, and so all the simplicity in some sense is gone. So it's very hard to calculate that optimal allocation. I don't know what it is. I mean, I can compare allocations, and so I can guess and then kind of do comparisons, but I cannot directly calculate the optimal allocation.
So I have a question about so this feature where you have increasing marginal costs for the dirty energy. So my understanding was that over the long run, like a couple hundred years, that non-renewables, like the real price of non-renewables has been relatively constant, which would suggest a flatter supply curve. So I understand you kind of want that convexity to get like balanced growth and that kind of stuff, but to the extent that we're talking about stuff happening over the span of a couple hundred years, and we look back at the data and we see it's been relatively constant.
Right.
Presumably this is going to matter a lot for the substituting away from dirty to clean. There's always going to be an incentive to use dirty if we keep finding better technologies like fracking and things like this to get it out of the ground at cheaper price.
Right. So kind of as you move along that convex curve, right? There's one thing that is happening is that curve is shifting because of the technological improvements in carbon, extraction, if you will. But the relative one, of course, is also affected. Kind of the relative costs are also affected by improvements in clean technology. And so the question is kind of whether that overall shift, right, is dominated by one versus the other. And as you said, so far it has been kind of, we've been in the relatively flat part, and those two things have kind of canceled out. But that doesn't mean that you're not moving up that curve a little bit, right? You're still moving up that curve a little bit. It's just that the relative shift in that curve has kept the relative price more or less constant. Now, eventually, right? I mean, this is like a physical thing, right? Eventually, just there's no more carbon, no matter what the kind of technology you have, and the key is that it's the relative technology, right? And so and the way we're calibrating the relative technology, the way we're doing that is by looking at the relative use of technology, fossil versus clean technologies, and so we're matching that, and that's giving us kind of the level effects in clean versus fossil. And that's a little bit faster for clean. So that gives us that clean is developing a little bit faster because we're seeing its use increase. Now, as you said, this is really important in particular for the effect of carbon. Why? Because when you impose a carbon tax, what happens is you decrease the use today, but then essentially you're shifting use to the future. Now, how much you're shifting use to the future, because the costs then in the future are lower, depends on how big is or how long is that flat part, right? So if that flat part is very long, then you're kind of really delaying it. If that flat part is not that long, then you're not delaying it that much. And so in the paper, we do a bunch of robustness exercise on that. Here you can see the effect of on different carbon taxes on temperature. You see there's a big decline in temperatures for a while, but eventually the effect kind of goes away. So the main effect of the carbon tax is just delay the whole use of carbon. Hopefully, at some point, and this is one of the exercises that we do in the paper, at some point comes, at some point is going to come a technology that is going to make all of this irrelevant because it's going to be able to capture carbon or something like that. And so then delaying, of course, is very useful. But that's really the main effect of the carbon tax.
Excuse me, you're not saying that we go back to use fossil fuels after 100 years or 200 years, right? What is the curve? What exactly are you saying when you say delaying the use of fossil fuels?
So you see my slides, right?
Yes.
So the baseline is the light green curve, and
Sure.
the other three curves are different carbon taxes that I'm imposing uniformly across space and over time. And so you can see how it's shifting the curve, right? It's shifting the curve in the sense that it's reducing the amount of carbon quite a bit today, right? Say with a 200% tax. But then, eventually the use of carbon goes up and has this kind of the same shape. So eventually, I'm actually going to be using more carbon as a result of the carbon tax. Why is that? Because in the baseline case, I've used so much carbon at this point that is really hard to extract. And so I prefer to use clean energy. While in this case, I haven't used that much carbon. So it's not that costly to extract. So that's an incentive to keep using it.
So you don't have in your model that carbon tax will induce innovation for more green energy?
So the only effect of through innovation is through this innovation in production. So there's going to be an effect through that, but that effect is relatively small. The one exercise that we do in the paper is introduce an abatement technology. So if you introduce an abatement technology, that eventually, say there's an abatement technology in 2100, and so then temperatures start to decline from there because, like I was saying before, emissions after that don't really kind of matter anymore. So to the extent that an abatement technology comes as a result of the carbon tax, that would be useful. But there's no, or at least we haven't incorporated so far, a mechanism by which there's a firm that is deciding on how much to invest in clean energy innovation, and that is incentivized by the price of carbon. That could be potentially included, but we haven't done so far. Yeah.
I wanted to ask something about diffusion.
Okay.
So you might think that, in terms of overall output, this might not be important, but in terms of the large numbers of people who are involved in low technology agriculture in many developing countries, can you think of any papers that try to figure out what essentially the diffusion of agricultural technologies is from sort of more developed countries to less developed countries based on similarities in the land and terrain features? Because it seems like the degree to which adaptations from developed countries feed into developing countries and change their ability to adapt to a changing climate might be important.
Yeah, the work. We have this other paper in which we try to incorporate agriculture and manufacturing, kind of differential effects of climate on agriculture and manufacturing. And there we have to, inform some diffusion parameters by sector. And the type of evidence that we use is the evidence that Diego Comín and company have used in terms of the use of particular technologies across time and space. But that's, it's like the tractor, right? Or particular types of seeds, but not, but of course there may be other type of kind of smaller innovations that are important too. There's of course the other literature, I guess, on diffusion. That, but a lot of these papers, kind of the traditional literature on diffusion, but a lot of these papers are much more local, right? I mean, so it's the kind of local diffusion of, I guess, there's the whole issue of kind of genetically modified the seeds and how those have diffused over space. So there's kind of a lot of good estimates of that. But again, this is much more at the local, regional level, right?
Yeah. Okay.
Anything else?
So I'll throw it. Let's talk about the discount factor stuff. Like that, I thought that was interesting in the paper, like about because you had this thing like where it was flipping, like do you know, like I'm just because I thought that was interesting about.
Yeah. So.
Oh, here it is.
So I think you're referring to this. So this is the effect of carbon taxes. So carbon taxes are very, I mean, they decline, they yield a decline in output today, and then over time, the economy, warms less, and as a result of the lower warming grows faster. And so eventually output increases as a result of, or real GDP in this case increases as a result of the tax. So you can see it for the different taxes here. And so every time you see a pattern like this, of course, it's all about how you value this piece relative to that piece. Yeah, and so that's exactly the discount factor. Now in this model, there's growth, right? So the economy is growing, and so you have to. I mean, the discount factor cannot be larger than I guess 1 minus the growth rate, and so what that implies is that we're kind of limited, and so the economy is growing about 3%. The economy is growing about 3%, and it kind of converges somewhere there. And so that means that 0.97 is kind of your limit for discounting, right? And so if you do that, you're really essentially valuing future generations the same way as you value current generations, because they're going to be richer, right? You value them a little bit less, but they're going to be richer, and so that's kind of compensates. And if you do that, and I mean, if you kind of exactly try to kind of get as close as you can to valuing everyone equally, then you get these positive output effects from kind of present discounted value of output effects from the carbon taxes and welfare effects. If you're below that, if you value if you kind of bias it towards current generations, then you get the opposite. You get that, it's not something you want to do. I mean, in the sense that these losses are relatively big. Now, this is overall for the world, right? From the perspective of particular regions, you definitely always want to do it, even for lower discount factors. But overall, for the world economy, if you have like the discount factor of 0.965, you don't really want the carbon tax, because I mean, remember, it's also about this intertemporal substitution in terms of you're just delaying the use of carbon, right? If on the other hand, like this abatement technology is coming, right, then you do want to use it. Then you do want to use it in general, and you get like a bigger effect in the case of 0.969. In the case of 0.965, barely. I mean, kind of the two things kind of even out a little bit. This is with an abatement technology that is forthcoming in 2100. So, that's the trade-off. I mean, it's a trade-off that, of course, has been mentioned and discussed a lot in this literature, and And this model
No,
exactly.
I think it was just so sensitive. It just looks so sensitive. That's what I mean. I had that sense that trade-off mattered, but here it's like it's just that path moves a lot. You know, that's must be the case, right? It's just,
well, no, this path is not moving. I mean, this path is, I mean, the discount factor has no effect on this path, right?
yeah. But the welfare, it's just like I moved.
This is just the calculation of the present discounted value, and because this is crossing one, right? And you have like the negative effects here and the positive effects over there. The present discounted value depends on the discount fact. I mean, whether the present discounted value is above one or not depends on the particular discount factor, and it is kind of I mean, these effects are not huge, and so you know by flipping it, you can definitely cross one, which is an issue. But you know the effect is relatively clear. That's why we are kind of, our argument is like, look, you know what the tax is doing. The rest is like a social welfare function, right? How do we weight these different changes, right? We kind of, the model is giving us what's going to happen and the effects over time, and then the rest is just how do you want to combine them to make policy decisions. And in some sense, the model has very little to say about that, right? I mean, that's kind of a society kind of decision on how to evaluate these things and what kind of social discount factor you want to have for that. But the path itself, that's what the model is in some sense designed to generate.
So can I ask another question? This is a little bit outside of the context of your model, but maybe fun to think about anyway.
Sure.
So, you know, if we're talking about, you know, 2-3 centuries from now, generations die, governments change, and, you know, we're talking about implementing a particular tax policy. And I guess this is outside of the scope of your model, but, you know, how have you thought about any way in which, you know, some kind of policy would be, you know, incentive compatible, for lack of a better word, you know, for 2 or 3 centuries?
Right.
Or issuing, you know, multiple century bonds to finance some kind of incentives or something. I don't know.
Yeah, I haven't, but I mean, I think that's a good question, and that in principle, this should allow you to think about. I mean, it's clear. I mean, these are all policies that are helping the future generations, and so the key is to how do we make future generations pay for it? And can we make future generations pay for it? And I mean, in some sense, we can't, because how much we can extract from the future is kind of limited. But you know, what the way we can extract resources from the future is by doing less today, I guess. Now that has kind of overall implications in terms of the total size of the pie. And so that's the incentive to do something today, that you know that we're reducing the pie. So but at the end of the day, I think it's very hard to, I mean, there's a resource constraint. I mean, there's only so much we can grab from the future generations, right? I mean, we can invest zero, I mean, I guess, but it's very hard to go beyond that. I mean, at some point, it's just very hard to extract resources from future generations. How do we do it? I mean, I think this is a general problem in economics more broadly, apart from climate change, that we don't have, I mean, it's the same thing is with inventions, right? I mean, how do we invent these great things? Future generations are going to use them. How do we make them pay? Right? How do we bring? Well, I mean, you know, is the present discounted value of that of the value of that innovation, but there's not enough money to how do we extract that from the future generations? It's really hard. So that's a constraint that society faces in all sorts of problems, and this is certainly one of them, right?
What is your message for the current generation? Shall we pay for the future ourselves? Should we make a contribution ourselves?
I mean, what this is saying is how much it's going to cost you, right? Depending on the tax that you impose. You know, for the first 100 years, it's gonna cost you substantially. Now, I think the issue is more, I mean, this is overall cost, but the thing is, it's gonna cost very heterogeneously across space, right? And that's, I think, the key issue, that the rich world today, if they don't do anything, right, they're not suffering that much, or the effects there are not that large. But it's the poor countries today that are paying the cost, right? And so the incentive, and so that also creates kind of, it's not only, I mean, you have two important inequalities here and two kind of equity concerns. One is today's generations versus future generations, which is what we were just talking about. But it's as important, or even more, and that one we can do more about. There's, you know, hot countries that are in general poor today vis-a-vis rich countries that are much less affected by this, and so have in general small incentives to implement any of these policies. And kind of one of the things that comes out of this is that's exactly, I mean, why are these policies not implemented? Or one kind of cynic interpretation of this, I guess, is that some of these policies are not being implemented because rich countries are just not that interested in implementing them because they're not as affected. And that's exactly what these maps that I was showing you tell you, right? I mean, this is really, really, really biased. I mean, these welfare effects are really, really biased. No, these are not. These are really, really biased towards the poorest regions today, right here.
You need some kind of altruism in your model, or some kind of cooperation mechanism to see that, right?
I mean, how do you make this? Look at this. I mean, look at this whole region here, right? Which are the rich countries in the world, right? Apart from maybe Australia there. It's like they're just right there, right? Right around one. So very, very small effects there. So how do you make them care about the fact that these guys are going to suffer they're going to face substantial losses from all of this, right?
Yeah, but the world is not independent of each other. The South is not dependent on the North and vice versa, right? So you try to understand that.
But I mean, this is taking
affect the North, right?
Definitely, but this is all taking that into account, right? I mean, to the extent that that interdependence has to do with trade, migration, innovation, and whatever channels we model, that's taken into account, right? So these numbers already take that into account, and the effect that you know, the negative effects that you see in Africa and the extent to which those effects affect the United States or Europe, that's taken into account. And to the extent that generates migration out of Africa and into, you know, some of these rich countries, that's taken into account. And the effect and the extent to which that extra migration creates a congestion in those receiving countries, that's, you know, taken into account. So that is, we're trying to incorporate all of those effects. You can, you know, we can quarrel about the magnitude, the particular quantification in the model, and I think, you know, there's certainly room to quarrel about that. But you know, the basic effect is there, right?
So just to kind of follow up on that, I mean, you have everything, all these guys are sort of just consuming and eating, right? And there's no kind of portfolio decision anywhere. So, you know, I might think that, you know, if the Chinese owned all of the United States, or the United States owned all of land in China, that the welfare effects would be very, very, very different. And I kind of can't think through it, like if that would somehow mitigate or exacerbate things. Have you given some thought to
Yeah, so that's a good that's a good point, a good comment. I agree. So right now we are rebating rents locally, right? But
You could do it globally, and that
but
would
exactly,
kind of,
but one we can do it globally, and that's kind of easy to do. So that's definitely feasible to do. I mean, like in terms of handling with the model, and that would, you know, bring another reason why I care about what's happening in the other places, and potentially more kind of shared fortunes in some sense.
Yeah.
So that's interesting. That's something that we can definitely do. I mean, I think the global portfolio way overstates the cross ownership that we actually have in the world. But you know, as an extreme case, it's I mean, you can weight it too, I guess.
Yeah, you could just sort of take it from the data or do something just to get a sense of if it makes much of a difference. And,
no, that's a good point. We can definitely do that. That's a fun thing to look at for sure.
And then just the last question is, you just chose like kind of fixed taxes instead of like phasing them in or some nonlinear path. Is there, how much better can we do with, or do you have some sense as to how much better we could do?
Yeah, so I think we can do better. But again, I cannot really calculate. I mean, that question would be a beautiful question if I can calculate the optimal allocation. I mean, that's the discussion that we were having with Mike, because then I could kind of get you the surface that we should implement, right? I cannot really do that. And so I need to come up with like schemes, right? And so I can make it a function of income, or I can make it a function of past emissions, or things like that. And I can try out different things. And so this is something that we haven't really done yet, but in principle, we can try different things out, kind of with the understanding that there's some potential, you know, Pigouvian logic behind this that we can apply at least at the local level, right? And so try to use that for us and kind of optimization criterion that is going to be incomplete here for the reasons that we've discussed, but maybe kind of gives us some guidance. I agree with that.
Okay. And just to follow up on Mike's point before, like, is there a innovation tax you could put in first before you start doing everything? Even just something like take it from some other paper.
You want a subsidy, right?
Subsidy. Yeah, a negative tax. That's what I meant. Something that sort of just kind of gets us a little bit closer to the first best before we start adding this other thing.
Yeah, I mean, again, I mean, it's gonna have to vary across locations and stuff, but and so figuring out exactly what that is, it's a little bit of a problem, but you could do something that, you know, makes the allocation more efficient. I mean, you can play with that. You can kind of, if you make it uniform and you play with the size, eventually it's gonna, you know, not be good anymore. And so you can find the optimum there, conditional on some functional form that you use. I agree with that. But I just don't understand why. I mean, I understand conceptually, but I mean, in some sense, the world is what it is, right? I mean, it's suboptimal in all sorts of ways, and we're doing policy on top of that world that is suboptimal in all sorts of ways. I mean, I don't understand.
Yeah, but the question is like, what's the policy? But what's the policy actually? When I see those welfare gains, what's the how is the welfare gain actually being delivered? Is it literally like, because this is a bad technology and I'm going to correct like the emissions issue? Or is because my kind of thing is like, well, maybe people aren't in the right location already. And, you know, global warming comes in and it pushes people to the correct spots.
Yeah.
And so that's
I mean, but to the extent
and then I put the tax on, and then that's a question about, well, global warming is actually pushing us towards the efficient allocation.
Right.
You know what I mean? This is conceptual, but
no, I know exactly what you mean, but in some sense, I think the beauty of some of this is that you can exactly, I mean, in the baseline scenario, you can see the extent to which temperature is doing that or not by looking at I think how population is evolving and kind of the implications for welfare of that climate, right? I mean, so that is, it could very, very well be the case that when you bring in climate change in this model, right, you have no losses. Exactly because of the argument that you made, which is, well, there's lots of land in the north, we're pushing people there, so overall at the end of the day, it's going to be good. And so that's playing out as well, to the extent that that happens, is playing out as well. And then I'm giving you kind of the combination of these numbers. Now I can start decomposing it by saying, well, what part comes from amenities, what part comes from migration, what part comes from innovation, what part comes from changes in population. I mean, I can decompose it, and that's what we're trying to do in the paper, right? Kind of
I saw that. Those were helpful.
Opening it and kind of partial out the differential effects in order to try to make sense of kind of what are the net effects. I agree that that's kind of an important thing to do.
Yeah, there's just so many externalities in the model, right? And you're kind of just using one tool to kind of deal with all of them, it seems like, in a more targeted approach. And
I understand that in some sense, when you think about it conceptually, is there's a lot of forces around that are affecting,
absolutely.
I mean, for sure. But in some sense, that's the world. I mean, the world has a bunch of functions floating around, right? I mean,
the world has lots of instruments too, right, to deal with externalities. But
I mean, you're calibrating to whatever a world, right? And the world has a bunch of policy in place that I'm sure I'm misinterpreting as technology, as amenities, as all sorts of things. But given the interpretation that I'm giving it, I can use it as a laboratory. I mean, as we know when we do all the time, right?
Absolutely.
Now the thing is, I can partial out many things, and so for example, one of the things that it was very important to do here, I think, and that is kind of an addition that we have in this paper, is the effect on amenities, right? So all the emphasis had been like on productivity. We think the effect of amenities is actually quite important. And once you partial out the numbers, etc., it turns out to actually be as important or more, certainly, in creating migration to the north, for example. So bringing that in seems relevant. But at the same time, well, that it's very hard to think about that without thinking about congestion. So you need to bring congestion, and congestion necessarily is an externality, right?
Right. But you might deal with it with some sort of migration, changing migration policy first, right?
So that's this migration as an adaptation mechanism and changing the migration policy that we were doing, which brings it a lot of rich effect. I mean, there's a lot of richness that we need to try to understand, and kind of it's
a great framework for doing it.
We're in the process of disentangling all and kind of understanding the different parts, and this is clearly not the final step in that. Sure. But the idea is to create this laboratory work that is kind of realistic in some sort of way beyond some sort of aggregate loss function, right?
Sure.
Great. Thank you, guys. This was great. Thanks for all the comments. Very useful for us, and pleasure seeing you all.
Sounds good, man. Good to see you too.
Okay.
Everyone should remember next week we have like a mini conference. We never announced it, did we, Kim? Oh, Kim's gone. Okay. We're starting at 2:00 next week for the 5 of you who are left. So